I still own
Oh,
the
you can
shares, by
still
the way.
remember.
Yeah, it's almost 20 years already. Now it's 2024. Every 3 months you get cash coming in. I mean, who doesn't like
Nothing to
that?
do with finance.
No,
Hey,
no.
Royston, it's great to have you here today. I've
Yeah.
been following your financial journey online ever since you're a blogger under the name of Music Wiz. So before we dive into the nitty-gritty of investing, right, can you share why you started a finance blog called this name back then, and why this name? Why do you choose this name?
Okay, yeah, that's quite interesting because at that time when I started the blog, it's about 2006. So I had just begun reading up a lot on investing lah, and in particular value investing. So I decided to chronicle my journey, and to show that value investing is a technique that actually works, rather than like other methods like maybe trading or like anyhow buying on tips and rumors. So I wanted to have a very structured process in terms of my investing, which includes analysis, and what I buy and sell. So I decided to start a blog to basically chronicle my journey and be very upfront about what I bought and sold at the time. And of course, why I use Music Waste is actually quite funny because back in army, I used to know almost every song they play on the radio. So people will say like, "Wow, you're like a whiz at music." So I'm like, okay, lor. So the name sort of stuck lah. So in the end, I start using Music Whiz lah, to refer to myself.
Oh, nothing to do with finance.
No, no. Luckily not
Okay,
finance
okay.
whiz or something. Yeah.
Okay. Great. Okay, then following which, right, in the course of doing research for this conversation that we are having, I also chanced upon your LinkedIn profile that you made the switch from accounting or audit, right? You from the big four, right? If I'm not wrong,
That's right.
to investing. So which is somewhat like my case, because I also came from accounting and finance, and then I went to the investing world, right? Can you describe what led to this switch and how you ended up becoming portfolio manager for the Smart Investor?
Okay, it's quite interesting, like you mentioned, because yeah, you're right. I did start out in audit. I was in Ernst and Young, but I think you can safely say I hated audit lah. So I just wanted the experience on my CV, and then I just wanted to get out and do something else. So after that, of course, most people will move into accounting, which is what I did for probably around like 10 years or so. I did like
Mm,
normal accounting, FP&A. Then after that, because I continued writing my blog during this time lah, the blog that we were talking about earlier. So it just happened that a fund manager from the UK chanced upon my blog, and he really liked my analysis. So he actually headhunted me to join a new hedge fund that he's starting. So that's what happened. That's how I got in my one foot in the door in the investment industry. And I actually joined him, but unfortunately the hedge fund didn't do so well. So after that, I moved on to another,
okay.
what you call an external asset manager, that manages about maybe like 500 million US at the time. So then I also started working there. And then after that, that's how I got some experience in investing in the hedge fund industry. So I think it's a very interesting journey because I've always had more interest in investing than accounting. So I'm glad I made the switch.
Yeah. And then how about the Smart Investor?
For the smart investor, what happened was actually my current colleague Chin, he approached me back then in 2018 to start writing for the Motley Fool Singapore. So that time, before the smart investor came along, we were actually the Motley Fool Singapore. But the Motley Fool Singapore actually shut down in late 2019, and then the same co-founders of the Motley Fool Singapore went to start the Smart Investor. So I just moved on from the Motley Fool Singapore to the Smart Investor. So I mean, the reason for writing full time is I think it gives me more control of my time, lah. And my wife loves it also, because I'm always at home, right? So then it's good, lah, in a sense, like
Yeah,
in terms of work-life balance, and
right.
of course, I can also manage my time better. I can always shop for groceries during off-peak periods. that's a
Get
that's an
lunch
advantage.
deals and everything.
That's right. So that's
Yeah.
basically a brief history of how this happened.
Cool. All right. I think pretty similar to my case as well. So I like the flexibility of just working from home and all that. Okay, so on to the next question, right? How did you start investing?
Okay, so investing basically wasn't really taught to me by my parents lah. I mean, my father just briefly mentioned it when I was like in my early 20s, but I actually wanted to grow my money more seriously lah, rather than of course just working and earning a salary. So I decided to read up on my own lor. So like I mentioned earlier, I started reading up on value investing books, and the techniques on how to invest, how to analyze financial statements. So luckily I have an accounting background. Okay, so I already know how to analyze financial statements. So I just need to take it a step forward, which is how do I make my money work harder for me? So that's how I
Mm.
started investing at that time. I think also through trial and error, making mistakes here and there, uh, that's how I actually began my journey, because of an intense interest to grow my money.
Or the intense interest to grow your
Mm,
money is the
yes,
driving force lah. Okay,
yeah.
okay.
I
But
think
when
for
did you
most
started?
people,
Like,
uh-huh.
when did you started?
Okay, I made my very first investment in December 2004 lah, by buying the IPO for Suntec REIT. I still own
Oh,
the
you can
shares, by
still
the way.
remember.
Yeah,
Wow.
it's almost 20 years already. Now it's 2024. So yeah, 20 years of holding Suntec.
Wow, Suntex, yeah. Oh, 20
Mm,
years. Wow, that's
yes.
incredible. So I
So
think you
that's
make it back through the distributions already.
Oh yeah, yeah, more than paid for my original cost already, all the
Okay,
distribution.
okay.
So it's like free money
Wow,
now. Yeah, yeah.
cool, man. That's so cool.
Thanks.
Okay, then, so what is your investing style or strategy? I can see from how you hold a stock for 20 years, that's something that we can also learn from it. So what's
Okay,
your
so
style?
basically my style is more value investing focused, but I'm what you call a more a value growth investor lah. So even
Mm,
though I invest for dividends, I also look out for stocks that have some growth lah. Okay, that is basically what I look for. So it's not pure growth, because pure growth will be a lot of stocks that may not pay dividends because they reinvest all their profits into growing the business. So for me, I look for a nice mix, a bit of dividends, a bit of growth. But I also tend to hold very long term. As mentioned earlier, like Suntec REIT is
mm,
20 years. I have stocks that I've held for like about another one I have held for maybe like 18 years. So I like to hold long term because I feel that you need time to allow the business to grow and realize its full value. So that's the reason
mm.
why if I buy a stock, I will hold it for a minimum of at least 3 to 5 years, a minimum. Then of course if I find out I made a mistake, then I will sell it and I will move on to something else.
Well spoken, well spoken. Like a true value investor.
Thanks.
Then can you share like what are your current holdings inside your portfolio and maybe some top picks that you can share with the audience?
Sure. Okay, so aside from Suntec REIT, which you know about already, so I
Yeah.
guess the top picks I have is one of them is iFast. So iFast is this financial technology company that has a platform called Fund Supermart. So it basically
Mm,
offers like unit trusts, shares, and bonds on its platform, and it's also growing quite rapidly. This company
mm,
because it recently won a big contract in Hong Kong. Okay, without going into details, it's actually poised to grow its revenue and net profits quite strongly this year. So that's
mm,
one of my better performers. And then I
mm,
also hold a company called Bausted Singapore. That's the one that I mentioned I held for 18 years, since 2006. So this is
ooh,
an engineering company that actually pays out very, very steady dividends. Even throughout like the global financial crisis and the pandemic, it was still paying out dividends. Okay. So even though you can't
mm,
see like crazy growth, but the important thing is that it pays out steady dividends. And that's
mm,
what I like about it. Lah. Then aside from that, I also hold a few REITs here and there. Lah. I think one example is like Maple Tree Industrial Trust, which is also a very steady dividend payer, and it's also has a strong sponsor in Maple Tree Investments. This one it pays
mm.
quarterly, so it's even better. So every 3 months you get cash coming in. I mean, who doesn't like that?
Yeah,
Yeah.
that's the
So
beauty of the quarterly dividends. But
yes.
other than Singapore, do you hold any US stocks?
Yeah, I do. I do hold some US stocks. Actually, just a smattering of it because US portfolio is just a small part of my overall portfolio, lah. So I hold
Mm,
some of the very recognizable names like Apple, Meta platforms, and then of course like Visa, Mastercard. Are some
mm.
of the examples of the US holdings I have.
So you are predominantly more of like a dividend growth investor, lah, if I were
Yeah,
to say.
correct, correct. Because
Uh,
the idea is to generate more passive income so that I don't need to work so hard. That's the
yeah.
idea. Yeah, and of course to supplement whatever income I have lah, also lah. So
Mm,
of course there needs to be some growth angle as well, so that eventually my portfolio can grow, so that it outpaces inflation and I can have enough for retirement.
yeah, yeah, yeah. That's my goal if I were to retire one day also.
Oh, that's
Okay,
great.
okay.
Wow, see eye to eye
Yeah,
on that. Yeah.
yeah, yeah. Eye to eye. Then, so for the few stocks that you mentioned, right, how do you actually conduct your research?
Okay. So basically, all the research is conducted using publicly available information. So, like for the Singapore companies, I'll use SGXNet, which is the basically like a one-stop portal for all your company announcements. financial
Mm.
statements, anything like corporate announcements, acquisitions, that's the main source of where I conduct my research. Sometimes I do read analyst reports and sometimes company transcripts if they have like conference calls, but that is like usually just another secondary source that I use. Yeah, so the primary
So,
source is just annual reports. Yeah.
so you basically just read everything that you want to know about a particular company. But
Yeah,
how do you
correct.
filter for these companies in the first place?
Okay. So that's a good question, I think. So, I have some ways lah. One way is to look at some of the 52-week low or high. So that's one way to identify whether certain companies may be mispriced. Like 52-week low, maybe it's because temporarily it's having a bad patch. So that's why it's
Mm.
hitting some lows. So that's one way to start the research lah. Not that it's always a good stock to buy lah. Then
Mm.
52-week high, of course, is the converse. It might be doing very well. So it's doing something right. That's why it's hitting a 52-week high. Then another
Mm.
method is to basically I have a few investment chat groups also. So sometimes other very smart investors also have ideas that they bounce
Mm.
around. So of course these ideas are just ideas lah. They're not tips lah. It's more like you
Mm.
also need to research on them. So if I get, let's say, company A, oh, I just want to find out more about it, I will just do my own research. But of course, it's better to have some sort of idea of where to start lah, rather than there's a big universe out there.
Mm. 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 Yeah, that's true. Yeah, good to know. Okay, so next question, like where do you park your money other than stocks? Because what I've been hearing is all stocks, right? Do you have
Mhm.
any money parked in fixed deposits or anything else?
Yeah, actually quite boring one lah. My money is all in the bank account. It is not
All
in
in the bank.
other kinds of funny securities like crypto or anything. No, I basically just use the OCBC 360 account because it's got a better interest rate than, let's say, your
Uh,
normal bank account. Yeah, so that's
High
where I
yield
park
savings
my.
account.
Yeah, correct. So it's basically where I park my emergency fund and my opportunity fund lah. So emergency fund is basically, as the name suggests, is where the money you need in case, like, touch wood, anything funny happens, right? And you really need the money. Opportunity fund is where you deploy money you need to, like when the market crashes, that's when you buy a bit of stocks. That's where the
Mm.
opportunity fund
Mm.
comes in. So you always need to have some spare cash around. That's what I believe. In case the market crashes, at any point in time, that's when you can take advantage of opportunities.
Mm. So talking about the opportunity fund that you have,
Mm,
right? Do you say you park like maybe 5 to 10% of your
mm,
overall portfolio inside there, and then it's like Warren Buffett, right? He has so much
mm.
cash, he don't know what to do. Do you have like like just a ballpark figure of how many percentage you put inside this opportunity?
Actually, not really lah, because this percentage tends to move up and down depending on like whether I save more this month or whether it's more dividends this month. So generally, I look at it more like an absolute amount of cash rather than as a percentage lah on my portfolio.
Mm.
So as long
Mm.
as I'm able to have a certain like dollar value that I can invest maybe like X dollars within 6 months, then I'll be happy to just invest this money. And then after that, I replenish it again through savings, salary, and dividends. And then basically the cycle goes on. Lah. That's how compounding works.
Mm.
You get
Yeah,
cash,
yeah,
then you invest the cash, then the cash generates more cash, and then you just keep rolling it into the market. But requires a lot of time, lah, obviously. It's
yeah.
not like
The money
overnight thing.
tree concept.
Yes,
Okay,
exactly. Yeah.
can nice. So now, can you share some of your investing mistakes throughout the
Hmm.
past
Yeah,
20
a lot,
years?
a lot.
A lot.
Yeah, a lot of mistakes. But I guess one big mistake in particular was my over reliance on so-called hot growth stocks last time when I first started my investing journey. Lah. So then I did not look at the balance sheet closely enough for these stocks. So I realized that a lot of them actually went bust luckily after I sold them. So one example is like Ezra Holdings. I don't know whether some of the
Yeah, yeah,
veterans
extra.
may remember that lah. It's actually an oil and gas support services company that manufactures vessels that support the oil and gas exploration lah. So the
Mm.
thing is, it was really growing and expanding very quickly back then in 2005 to 2006. But what I didn't notice was that it just kept piling on debt on its balance sheet lah. So eventually, of course, this has to catch up with the company lah. Meaning they in the end
Mm.
they have to pay a lot of finance costs and of course, the oil prices also are very cyclical, right? So
Mm.
when things are going well, then of course you're doing well, reporting better profits. And when things are not doing well, you're left with all that burden that you have to service. So in the end, the company actually went bust lah, eventually. But
Mm.
luckily, I managed to identify that they were taking on just way too much debt and managed to sell out before they went bust. Then
So your
mhm,
accounting knowledge came into place lah. It helped you
yeah,
to identify that you got too much
mm.
debt lah. Okay,
I
okay.
guess accounting is one thing lah, but it's also the ability to just spot like when management seems to be biting off more than they can chew lah, which in many
Uh,
cases happens because not because the CEOs are incompetent, it's because they get so caught up in the moment, just want growth and it's all going so well, they just don't realize that something bad may happen. You see. So I would say that sometimes they just don't anticipate it. So another mistake I can think of is probably buying a stock with a dividend yield that's just way too high lah. So that's something that you should watch out for also. Like
yeah.
people say, "Oh, this stock dividend yield like 15%," but I'm like, but can it really pay and sustain such a high dividend yield? So there was a stock called Design Studio that I bought once upon a time lah. Okay, and
Uh,
this one I think used to have like a 10% dividend yield, something like that lah. So it
mm,
was paying out quite a bit of its cash. It's not really growing, but I mean, if you just get 10% every year, you'll be quite happy, right? I'm sure. But the
mm,
problem is it couldn't really sustain this kind of dividend yield because the business, okay, so in a nutshell, the business is actually, they are like, think of it as an interior designer. Lah. They actually manufacture their own furniture, like premium furniture, and then they sell it to companies or they sell it to individuals. Lah. Okay, but the problem
mm,
was there's a lot of competition out there, right? I mean, like you can think of IKEA and you can think of other furniture manufacturers. So in the end, they couldn't keep up with the competition. Free cash flow dropped, dividends got cut, eventually eliminated, and right now the company is actually bankrupt and it doesn't exist anymore.
mm.
So luckily, also I managed to sell out my entire stake before it went bankrupt, but I did lose quite a substantial chunk of my money, lah. Unfortunately, but
Oh,
learned
okay,
a
okay.
very big lesson from that, lah that
Mm.
sometimes 10% dividend yields are not sometimes, most of the time, it's not sustainable. Yeah.
Okay. What
Something
about
must be
REITs?
wrong. Sorry?
Then what about REITs? Like REITs do, like during
Mm,
this especially during these past 1 to 2 years, a
mm.
lot of them give quite high distributions, like more
Yeah.
than 10% yield. What's your take? Like
So
is
so
there any
basically, okay, so to digress a bit, for REITs, if you look at some of the better REITs, and I mean the really strong ones with good sponsor, high quality assets, all that, the dividend yields are around 5 to 6%. They won't hit the double digit level. If you hit the
mm,
double digit level, I'm sorry to say there might be something wrong, or there might be a DPU cut coming along. Lah. Okay, so that is basically what the market is pricing in. Lah. So I tend to
mm,
avoid those double digit yields one, even right now. Lah.
mm.
Yeah. Yeah.
Be on the safe side lah.
Yeah, it's always better to be safe because eventually you can get your dividends, but you lose your capital. I rather
Yeah,
not lose the capital. Yeah.
yeah. That's cool. That's cool. Thanks. So maybe to touch on the first one, Isra Holdings, right?
Mm,
Um, do you like go to the attend AGMs to see,
mhm.
to gauge their body language of the management team or things like that?
Yeah, interesting that you asked this because for Ezra, I did attend like almost every AGM and I spoke to the
Uh,
finance director about the debt load. And I
mm,
think there was a point when I asked him very point blank, like, are you guys going to take on like even more debt, or are you like going to stop taking on debt and start paying down your debt and generating some free cash flow? Then he didn't give a very convincing answer. That's all I can say. And that
oh, okay.
actually convinced me to like sell my shares because I think they're just going to keep loading up on the debt. So it's more like you get the feel that they're not going to stop here. And I think the
Mm,
AGM did help me
yeah,
to assess so-called that particular executive, and how they're thinking about what they want to do with the business. Lah. Because if you don't generate free cash flow, you might end up like high flux. Lah, everybody knows what happened to high flux. It was quite a
yeah,
high flyer, but it didn't generate cash flow for most of the years that it was operating, and that became a very big
yeah.
problem for it
Mm,
eventually.
wow. Okay. Thanks for sharing on this, man.
Yeah,
Okay.
sure.
So, next question. What's your retirement plan like?
Wow, this is actually quite a tough one to answer because in the first place, how do you define retirement? A lot of people think of retirement like,
Yeah,
wow, you
actually,
relax on the beach, with a pina colada and all that. But actually, to be fair, I've actually spoken to people who retired lah, and it can get quite boring one lah. So the best kind of retirement plan to me is like working at your own pace without having too many deadlines and without having like the stress of like a job and a boss to report to. Okay, so that's
mm,
how I define retirement. So what is my retirement plan like? The idea is to build up more of a dividend stream lah. currently probably still insufficient to support my expenses. So the idea
Mm.
eventually is to get your dividends greater than your expenses. It's a very simple equation.
Mm.
The problem is that it's quite hard to get the number higher lah. I mean, everybody knows dividends fluctuate,
Yeah.
expenses
Correct.
don't. Expenses only
Yeah.
grow. Yeah.
Yeah.
So the thing is,
True.
the idea is to try to get your dividends up to a level where you're quite comfortable, and of course,
Mm.
then you can supplement with a bit more income, like more writing here and there. Then
Mm.
eventually, I can like retire lah. If it you know,
Mm.
for better use of the word.
Actually, I have the same plan also. Like,
Mm.
as long as the dividend income, like maybe on a monthly or quarterly basis, can be more than the monthly expenses, then more or less there already lah.
Yeah, exactly. Yeah, but
Yeah,
it's just that it takes a lot of time and a grind
to grow the
to get it
capital.
there. Yeah, yeah. It's
Okay,
compounding.
okay.
Mm.
Okay, so maybe last question for
Mm.
us. Any advice for the readers out there?
Yeah, yeah, of course. I think one good advice is when you're dealing with the stock market, you always have to be prepared to look for the risk first, lah.
Mm.
Don't keep watching out for the rewards because a lot of people get caught up in the rewards, meaning like when your share price is going higher, then you get very excited. I mean, I felt the same thing before, lah. It's like a rush of blood to the head, lah.
Yeah,
Then when you neglect the risk, that's when eventually it may come back to haunt you, lah. Like you start
yeah.
losing like serious money, and that you cannot recover from, lah. So that's
Mm.
one thing. And the next thing I would advise is to always keep some cash on hand. I think I mentioned this before. So don't
Mm.
invest like every single dollar into the market and then just hope that everything goes up because it's probably not going to happen. Okay,
Mm.
there will be times when the market just doesn't perform well. Certain stocks don't perform well, and of course, if you have the cash, you can buy more. If you don't have the cash, all you can do is to just sit there helplessly, while share prices go down, and you can't
Mm.
make use of the opportunity to buy more. So I think the example was back in global financial crisis. I just continued investing even when it hit like the lows. During the global financial crisis, I just kept pumping money in. Okay, and I
Mm.
guess the last piece of advice is you really need to understand and control your emotions and psychology. Because no matter how
Mm.
much analysis you do on spreadsheets or whatever you use on calculators, it's not going to help you if you don't have basically the guts to buy when share prices are dropping, or you get caught up
Mm.
in the hype, and buy when share prices are too high, valuations are too high, and then eventually you end up losing money. So that is something you always have to watch for, lah, the emotional aspect of investing.
Mm. Yeah, yeah, I think that's very true. Especially on the part whereby you dollar cost average and you have
Mm,
a opportunity fund over there, right? To
yeah.
pump in when things are going bad, but you are maintaining your emotions because you still have cash out there, right? Yeah,
Mm.
yeah.
Yeah,
Thanks a
having
lot for
cash
sharing.
also important. Yeah, yeah, definitely, because
Yeah,
it keeps your emotions more balanced. Yeah.
yeah. So having the extra cash there.
Mm.
Okay. Thanks, Royston, for joining the webinar.
Yeah,
Thanks.
most welcome. Very happy
Okay, so
to.
I will see you again. See
Okay,
you
sure.
again.
Yeah,
Yeah,
we
I'll
catch up
keep you
again.
to
Thanks a
new.
lot for this. Okay.
Yeah. Thank you.
Right.
Bye bye.
Okay, bye.
Before we end off, if you find the video helpful, I will appreciate it if you can help me to tap the like button and share the video so more people get to know about this video. Next up, don't forget to check out this video over here if you have another few minutes to spare. And I will see you next time. Thanks for watching and ciao.